On behalf of Edelweiss, let me welcome you to the Tejas Networks Q4 18 earnings call. We have with us senior management of Tejas Networks, headed by Mr. Sanjay Nayak, along with senior members of the management team. Without further ado, I'll hand over the call to Mr. Sanjay Nayak to start the proceedings. Thank you, and over to you, sir.
Thank you, Pranav. Welcome, everybody. Good afternoon. This is Sanjay Nayak from Tejas. I have with me my management team, which is Venkatesh Kadiyar, our CFO, Kumar Shivrajan, our CTO, and Arnav Roy, President of our Optical Division. So, in fact, I hope you all had a chance to download or review the presentation that has been uploaded on our website, because we plan to go through that presentation for the rest of the call today. We'll try to finish the presentation in the next 30 minutes or so, and then we'll leave another 30 minutes for Q&A that you may have. So I would start off with the financial update, and I would actually request Venkatesh to walk us through the slide number 3, which has the title Q4 Financial Update. Venkatesh, please.
Yeah. Our FY18 standalone and consolidated financial statements were audited by our statutory auditor, and they have expressed an unmodified opinion on the financial statements. As we explained in our earlier quarters, our reported revenues are exclusive of excise duty for FY17 and till June this year, post which revenues are reported net of GST. In addition, during the last financial year, we had component sales on pass-through basis to our contract manufacturers, which is not the same case in this financial year due to the change in our manufacturing model. As a result, for equivalent comparison, we will use revenue net of taxes and pass-through sale of components. For Q4 18, consolidated net revenues were 98.7 crores, a decline of 61.2%, and our net profit after tax of rupees 21.1 crore, a decline of 56.7% on a year-on-year basis. Our FY18 revenues declined by 9.6% to 740 crores compared to 819 crores in FY17.
Going to the next slide?
Yeah. Our revenue breakup for the year was about 82-18 for India International and 90-10 for products and services, whereas FY17 65-35 for India International and 96-4 for products and services. There were 2 customers whose contribution to revenues was in excess of 10%. They contributed 57% of the total revenues. In the previous year, the same was 2 customers contributed to 46% of the net revenues. Revenue decline during the year was primarily due to late receipt of the few large orders, which will get revenued in this current fiscal. Domestic revenue grew by 15.5% on a year-on-year basis, largely from PSU customers. However, international revenue saw a decline of 54% on a year-on-year basis, primarily due to decline on OEM revenues, which was higher than expected. Our continued investment in international direct sales is showing a positive sign as we see strong business momentum building up across customers in Southeast Asia, Africa, and USA. Operating expenses. We continue to invest in R&D and international sales. Our R&D costs on a gross basis grew by 12%. Sales and marketing costs grew by 13.3%. We have added new employees in Southeast Asia, Africa, and USA. Our overall operating expenses increased by 8.9% on a year-on-year basis. Our EBITDA declined by 6% on a year-on-year basis due to decline in the revenue. However, as a percentage of revenues, it increased from 20% to 20.7%, primarily on account of better gross margin. The year-on-year increase of 26% on profit before tax and before exceptional item is due to increase in other income and reduction in finance charges. Next slide. Now coming to deferred tax assets, which we have recognized. As Ind AS requires deferred tax assets to be recognized for the carry forward of unused tax losses and tax credits, and we have recognized a deferred tax benefit of 56 crores in the opening reserve of 1st of April 2016, and in addition we have recognized rupees 40 crores and 24 crores of deferred tax benefit in the profit and loss account during FY17 and FY18 respectively. Next slide. While the profit grew from 93 crores to 107 crores, EPS for the year was 12.41 per share, decline of 12% on a year-on-year basis on account of the large capital base post-IPO. We continue to see good progress in our working capital management, which saw a reduction of 133 crores for the year. The working capital reduced by 37 days to 141 days. DSO reduced by 20 days to 135 days. Days payable increased by 28 days to 100 days. Inventory days increased by 12 days due to the fact that we had built some inventory in anticipation of certain orders which came late, and the same will be executed in Q1. In addition, goods in transit as on March 31st was about 17 crores. We generated free cash flow of rupees 171 crores for the year as compared to 98 crores in the previous year. Our cash and cash equivalents, including investment in liquid mutual funds and deposit with financial institutions at the end of the year, was 513 crores. Dividend policy. The board has reviewed and approved the dividend policy of the company after taking into consideration the strategic and operational cash requirement of the company in the medium term. The board has decided to distribute dividends up to 25% of the free cash flow of the corresponding financial year, subject to applicable laws and requisite approvals. Overall, while revenue declined during the year, we improved our gross margin, reduced our working capital and DSO, and improved free cash flow generation. Now I will ask Sanjay to take over.
Thanks, Venkatesh, for giving an update on the financial side of things. Let me walk you through the next few slides. I'm on slide which says Q4 corporate updates. And in terms of what's going to happen in terms of the sales and the team size, I would update in the next few minutes, after which I'll ask Kumar to give you an update on the technology side. So in terms of the team, we actually added a headcount in Q4 from 697 to 707. And on an annualized basis, we increased our R&D headcount by 21% and sales and marketing headcount by 35%. So as you can see, we made very significant investments in R&D and sales. Our attrition was well below industry levels at 9%. We won a few awards in terms of our products as well as in terms of the other business growth. 20 patents were granted to us during the year, and that makes the total cumulative grant to 76 patents. And we have applied as on date for 341 patents for our R&D efforts. Coming to the next slide on the FY sales update. So as Venkatesh mentioned at a high level, India contributed to 82% of the revenues, which is up from 65% a year back. In India, particularly the government business has been very, very strong. As you know, that there's been a lot of build-outs of BharatNet, which happened during the last fiscal year and will continue to happen during this year. And we got significant portions of that. So we had a strong showing in BharatNet Phase 1, and we have a healthy funnel building up for Phase 2. So some of these orders, in fact, a part of the order that we got last year was for Phase 2. And in addition to what orders are in hand, we also won a few tenders through our system integration partners where they are L1, and we should expect some of those orders to also start flowing in as we go forward. In addition to the BharatNet, we had a very significant percentage of wins and a sizable large orders from the utility segment, which is railways, power, oil and gas. And these are networks that these entities are building for their captive requirement as well as for surplus bandwidth that they sell at times to the operators. So I would say the India government overall has been a very strong growth last year and will continue to be this year. On the India private side, we continue to get good business from our existing customers. A few large orders slipped into this year, which we should be getting. These are from large private customers who are our run rate customers. And one other positive development which we have seen during the year is that we've been working with our existing customers to see if we can fit into some new applications. We are actually at a fairly advanced stage in many of those discussions, and we expect to see additional business coming out beyond what used to come out in the past from our existing customers because of these new applications. On the international side, the OEM business declined. In fact, this has been, if I were to put it across for all our sales, this has been a bit of a surprise for us because we did expect the international business to decline, but it declined at a rate which was much steeper than what we had anticipated. Because it looks like that we have an overlap with our OEM partner in terms of the metro segment, and we did see that they were positioning our products at much fewer locations than they should. We had expected that our direct sales would have made up for the numbers in terms of the shortfall for OEM. So while we did make a lot of progress, we added 30 new customers on the international side. We added, of course, from a sales team perspective, we added a strong leader for Southeast Asia, Africa, and we have had a few mid-level sales guys in the U.S. But the actual traction in terms of bookings and revenues for last year is still work in progress, where we have seen a lot of success, but the results of that should be seen in the current financial year. Specifically in America, we've registered many wins for network modernization. This is one application where our products seem to have a sweet spot, and we should see a lot more traction and business growth in the current financial year based on the wins we have and the trials which we have successfully completed. Africa actually grew year-on-year quite healthily, and we have not only see a growth in Africa, but we are also seeing a very strong pipeline. As I mentioned earlier, we have expanded our African operations. We have set up a new office in Nigeria, which is covering West Africa, which as an economy is recovering very well. So we actually have Nigeria as a West African outpost. We have Kenyan office covering the East African. We have a Johannesburg office covering the South. And our Dubai office is covering the North African deals in many of those countries, in addition to covering Middle East. And a few countries in Middle East, again, we have made a lot of progress in terms of successful trials and large opportunities that we're looking at. Southeast Asia, again, has been something that was a reasonably large piece of our business. So there are a couple of large customer orders which we were expecting last quarter, which are now going to come this quarter. And we see a very strong pipeline of business from existing customers in Malaysia as well as in Vietnam. And in addition, we see some potentially large deal working out on a government-to-government basis in the region based on the line of credit that the Indian government has made available for ASEAN. So overall, I would say that the focus on the sales has created a very strong foundation, especially on the international side, and the fruits of the success we are very confident will show up in the year to come. Coming to the next slide, the big picture of our own industry. So as you all probably know, I'm on the next slide saying global data explosion driving optical capex. So net-net, the world is still consuming a lot of data. 78% CAGR in mobile data is expected for the next many years. In India, we are still rolling out 4G, and clearly after that, the 5G opportunity, everybody knows that will require a lot more deeper fiberization, a lot more capacity build-outs, a lot more upgrade of equipment in terms of latency and other requirements. So there's going to be a whole new set of expenditure around 4G and 5G in the years to come, which is reflected in the fact that the global optical networking revenues are expected to go from around $16.7 billion in 2018 to around $19 billion by 2021. And still, I think the effect of IoTs is still to be felt into the networks. We are still struggling to have 87% of the humans on the mobile or telephone network, and we have probably 10 times more or 100 times more devices in the form of IoTs which will come on board onto the network over the next few years. So overall, I would say there's a lot of business opportunity at a macro level. Coming to India, which is one of our focus markets, we are clearly seeing a lot of growth in data and broadband. The subscriber base on broadband is going to grow quite healthily. And as you would have read in some of the reports, India has already become the #1 market in the world in terms of mobile data usage. And in terms of, Facebook users or many other criteria that people measure, looks like India is really a market where for the next 4 or 5 years, we will continue to see sustained growth in terms of data consumption, which correspondingly will result in, higher capacity optical networks that we serve. From a regulatory and operator perspective, we have seen announcements by telcos for significant capacity expansion in terms of fiber and 4G, and for now, and then, of course, in a couple of years, they'll start on the 5G side. And, at the last estimate that we are tracking, more than 60 to 70,000 crores of capex is planned, and we expect a significant part of this is going to come into the optical infrastructure, which is falling behind. And as you know that the TRAI report for 2022 recommendations is out, and they have suggested that the least that India will do is go from 20% cell-site connectivity to 60% cell-site connectivity over the next 4 or 5 years, which essentially would mean a corresponding increase in terms of, optical transmission equipment. The BharatNet Phase 2 implementation we have talked about in the earlier calls. The implementation has started. As I said, we have started to get initial orders. A lot of tenders are in the pipeline as we talk, at the state levels in particular, and some of the states are augmenting the funding they're getting from the central government to build even larger networks, and we do see around a 3,000 to 4,000 crores opportunity for the kind of equipment that we do in terms of the BharatNet Phase 2. We expect these rollouts to be spread between this and the next calendar year, and we should see a significant kicker on the business from this side as well. The PMA policy continues, and we expect that it would be rejuvenated with more force in the coming days. You would have all been reading about the government push to nurture a 5G ecosystem within India. I must tell you that we've been working closely with the government as well as the standards bodies for 5G, and a lot of the standards related to optical as well as for the rural broadband are being contributed from India and in particular from Tejas' team as well. So we do believe that the 5G will be a disruptive force where the amount of software which will start playing the role into the network architecture, the fact that the network architecture is going to go through a significant change, we believe this will present an opportunity for new companies to really dislodge the incumbents, and that's something which we are lining up. Last, not the least, I would say we have seen a reasonable push from the Government of India. I am myself the co-chairman of the Telecom Export Promotion Council, that there is a big push to get digital connectivity projects in ASEAN region or African region funded by Indian government line of credit, and we have made some decent progress in few countries to actually get to project proposals which can potentially result in the success in the next few years. Next slide is about the strategic priorities for growth. So as we had mentioned earlier, we are focusing our efforts on two different directions. One is on the sales side. We clearly want to make sure that India, which is going to be growing quite a lot, we are well entrenched and we want to continue to really expand our market presence in India. And we think that this fiscal year will actually start seeing those numbers moving up for us. Government spending continues to be unabated, and we feel that BharatNet Phase 2 as well as some of the other spending that the government is planning will actually fructify. Global side, we have had a very focused strategy. So we are doing Southeast Asia, we are doing Africa, and we are doing US as three major markets. And all those three markets, I think we've put significant efforts in terms of building a foundation in the last few years, and we believe that this is the year where we should start to scale those revenues upwards. On the R&D side, and Kumar will of course walk you through a little bit more, but the whole purpose is that with 4G and 5G, the need for higher and higher capacity systems will continue to happen, and more things are getting packetized. So we are really having one dimension of technology focusing on that. And secondly, we do believe that there are going to be 4 or 5 very important applications which are going to be driving the growth in the telecom industry, and Kumar will be again talking about those. And we're focusing and making sure that in those applications, we have the best-in-class products based on the benefits which we have of our fundamental architecture, which is really software differentiated. So at this point in time, I would really pause and get to the last part of our sales strategy for the next year. So in India, as I said, build on the success of Phase 1 for BharatNet and Phase 2 on the government side. We see a lot more deals happening on the OTN and DWDM product lines, and we believe that we have very competitive portfolio over there. And the utility segment has been performing very well for us, and we expect that like the last year, it'll again be a pretty good segment for this year based on the visibility we already have. On the private side, we are targeting new applications with existing customers to increase our wallet share. We should start seeing results of that in terms of new wins and new applications, hopefully starting from this quarter itself. We have a very integrated and converged access product combining GPON, which is FTTX, Ethernet, the LTE, and the transport. And we have started to see that as operators are trying to find out ways to streamline their network architecture, the product portfolio that we have, which is a converged platform, makes a lot of sense for them. So we should see success out of that. On the emerging markets, we will continue to be focused on Southeast Asia, Middle East and Africa, and we will continue to add a little bit more resources in terms of manpower in each of the regions. And in Americas, I think this is one area where a lot more attention of the company will go. We wanted to make sure that last year was used for actually getting initial success, getting a lot of trials done, setting up our ecosystem in terms of support, et cetera, et cetera. But this is the year we believe that we should be able to scale up our revenues. The OEM relationship, we will, of course, continue to nurture, but we do believe that longer term, this may or may not contribute to much part of our revenues in future. Mexico is another area in the North American continent that we've had some good success, and we expect to build on top of what we already have, and we again see a good funnel and pipeline of potentially larger deals than we have seen in the past. Now I'm going to request Dr. Shivarajan Kumar to walk us through the technology strategy and the product strategy for the company. Kumar, please.
Thank you, Sanjay. So Sanjay focused on the overall market as well as our sales strategy. I'll now walk you through what are the main application areas for our products that we are targeting, this year and in coming years. We have 4 major application areas for our products, and this is shown on the slide. The first is, mobile backhaul. This is for 4G networks today, and it will be for 5G networks tomorrow. The second is bandwidth services, and these services are for enterprises, data centers, and even other telcos. The third is broadband access, which includes GPON and wireless based on LTE. And finally, network modernization. In the following charts, I will take you through each of these applications. I now turn to the next slide, which is on mobile backhaul. Backhaul is an important aspect of the mobile operator's network. It's second only to the operator's radio network. Operators are facing immense cost pressures today, much more in India than elsewhere, and much more than at any time before. But they still need to invest in fiberizing their base stations because the volume of data traffic that is generated by 4G today, primarily due to video streaming and similar applications, is so large that microwave networks are unable to cope. The advent of 5G, which will happen by 2020, will create the need for even more fiberization and faster growth in the backhaul market. And operators are already preparing for the advent of 5G. The primary goal of this backhaul network is to reliably carry the huge volume of data that comes from the base stations and that is headed for the internet. While carrying this huge volume of data, it is also important to meet the latency requirements of the mobile users because a lot of the traffic is video, and to also do it at the lowest cost possible. Our packet transport products combine the low cost of packet switching with the quality of service that is needed for mobile backhaul. And therefore, we have built them almost purposefully for this application. Our products are based on MPLS CT today. They are CET 2.0 certified. They're also future ready, and they're able to carry 5G traffic with only a software upgrade. In addition, on the management side, we support the next generation of network management, which is based on SDN or software-defined networks. So this is one application of our networks, of our products. I'll now discuss the next application, which is bandwidth services, on the next slide. One of the applications of our products going back for many years has been to provide bandwidth to enterprises, to data centers, and even to other telcos, because some of our customers are carriers of carriers, and their customers are other telcos. In this market, which is, the bandwidth range can go up very high, from as little as a few megabits to as much as 100 gigabits. And today, all the services are invariably Ethernet. There are legacy services, which I'll talk about on the last slide. The market for the Ethernet bandwidth services is rapidly growing. and by 2020, it will reach $70 billion. So you can see on this chart that it is growing really fast. The same packet transport products that are based on MPLS TP and C 2.0 can be used for bandwidth services here when the requirement is, in the megabits or smaller than 1 gigabit. But for higher capacity bandwidth services, we need other technologies which are OTN and DWDM, and we use this part of our product portfolio to address this segment. Our 100 gig alien wavelength solution, where we can launch new 100 gig waves on existing WDM networks, and these existing networks can be built or often built by competing vendors, has been particularly successful in the last year. This is interesting to telcos because they are not beholden to their current vendor for new capacity additions to their network. We had numerous deployments of our 100 gig alien wavelength solution last year throughout the world. I'll now discuss the third segment, which is broadband services. A large market, a new market segment that we started to address a couple of years ago, in addition to optical transport, was residential access. There are two technology solutions we have for residential access. One is based on fiber, and is based on GPON technology. And the second is wireless access based on LTE. And LTE is, of course, useful where no fiber is available. GPON itself, which is the primary form of wireline access around the world today, has a large global market that exceeds $7 billion. Our differentiation in our GPON offering is the development of rugged customer premises equipment. So these are boxes deployed at the customer end, and these can be deployed in harsh environment conditions and remotely managed. This is, unlike the GPON modem that you may have in your urban home. This is intended for harsher environment conditions and also remote manageability. Over 50,000 of our GPON customer premises equipment are deployed today in BharatNet, and our BharatNet GPON network really forms the backbone of Digital India. Where fiber is not available, we have deployed our LTE-based wireless access solutions. Our initial deployments have been in Malaysia for rural broadband, but we are actively engaged with carriers across the world for similar deployments. And where fiber is either hard to lay or not available today, wireless is a great complementary solution. Both our GPON and LTE solutions will be upgraded to higher speeds in the coming 1 or 2 years, and with capabilities which exceeds what they have today. Specifically, GPON will get upgraded to 10 GPON and 4G to 5G. In the case of GPON, we are also pursuing open source software networks so that our OLTs, which are the boxes at the head end, can be deployed in virtual cloud environments, which are becoming popular today. In addition to residential access, our GPON and LTE solutions can also serve the internet connectivity needs of small and medium enterprises. Finally, in addition to these two forms of access, we also have an Ethernet switching and IP routing portfolio that can address the needs of large enterprise networks such as state governments and industrial campuses. The final application I want to talk to you about is network modernization, which is on the next slide. Telecom operators around the world, and especially in the United States, which has a rich legacy of deploying telecom for many years, have a large legacy infrastructure based on SONET. And this infrastructure largely carries TDM traffic, such as fixed-line voice and 2G mobile voice. Even considering equipment that was installed more than 7 years ago, this network modernization equipment is worth several $1 billion annually. However, at this time, market analysts have not started to develop specific estimates for this market segment, which I'm confident they will do so in the coming year or so. These operators need to modernize their legacy network infrastructure and install packet-based solutions. But they need to do so without changing the endpoints, which are based on old TDM interfaces. While they modernize their network, they also want to retain the simplicity of the network operations, especially provisioning of new services, because that's what their current operations team is trained to do. They also need to be able to recover from network faults within 50 milliseconds, which has always been a challenging aspect for transport networks. Our circuit emulation solutions can carry all the legacy TDM traffic on a new packet-based network, along with the modern traffic from 4G and 5G and internet access, while still meeting all the stringent requirements, including 50 millisecond protection. Our new platforms are based on software-defined or reprogrammable hardware platforms, like pretty much all our products. We also understand the scale of the solutions that are needed because some of these telco networks are extremely large, and so our network modernization solutions are built to be scalable today to meet the needs of the largest telecom operators in the world. So with these solutions, we can modernize any operator's telecom network today. So these are the 4 applications we are targeting with our products today and in the next 1 or 2 years. After this, I'll now hand over to Sanjay to summarize our presentation.
Thank you, Kumar, for giving an overview of our R&D efforts and the technology direction we are going and the application that we are actually solving for our customers. So really, I wanted to quickly recap everything that we have talked today. So at a very high level, as a first product company from India, we really clearly established strong technology and market leadership. We have competed hard in India, which is the world's most competitive telecom market, and we are continuing to do well there. As Kumar talked about, I think we have a significant R&D focus and a very, very strong product line. When we compare our product line to the rest of the world, in whichever part of the world we go to, we are seeing a significant market acceptance and success. Our fundamental programmable software-defined hardware architecture is really something which allows us to do a lot more development, a lot more rollouts of technology much faster than anybody else. And from a macro point of view, the data growth, the 4G and the 5G is only going to be benefiting our industry in terms of the equipment space that we operate. And with 5G, really, we do believe that there will be a disruption in the ecosystem of the industry in the world. And we believe that with the software focus, with the edge device focus, we seem to be in a very good position to step into that role. The geographies that we are targeting, those are really the hotspots in the world, whether it's India, whether it's Southeast Asia and Africa and US. And I think we've had a very focused approach in terms of making sure that we win in these markets, which is coming in the form of customer success as we are seeing. We have done a lot of hard work last year in terms of building the sales force. We'll continue to do it this year, but we expect to see a lot more results in the form of actual tangible outputs. And last but not the least, I think there were 2 aspects where in an industry which is otherwise very, very tough to operate, and I'm sure you would be tracking the global peer groups for our business, we have been able to demonstrate that it is possible to deliver significantly good financial performance. The cash flow management and the working capital stuff that Venkatesh talked about earlier also gives us confidence and comfort that we had given a guidance that in 4 quarters will be around 130 days of working capital. I think we're almost there, and we still have a quarter to go. So overall, I would say that the company seems to be in good shape. We have had a lot of traction in terms of the business. The backlog that we started this year is the highest ever in our company's history. The number of wins we already have, which should convert into POs soon, the kind of pipeline we are seeing across different geographies, it gives us a lot of confidence that we are, quite well groomed for success in the next few years. And as our revenues grow, you would have seen from our financial model, the profitability will automatically follow and expand. So that's kind of what I would give as a summary of where things are in the company today. And maybe this would be a good time to take a pause, and then we'll be happy to take questions from the audience.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Mukul Garg from Haitong Securities. Please go ahead.
Thanks for taking my question. I have one question each for Sanjay, Venkatesh, and Kumar. So Sanjay, I have a long-term query on revenue, how to forecast the revenue. We saw a decline in top line in FY18. The issue was primarily because of both domestic as well as international consideration. While we understand that you have limited visibility in the timeline of order inflow, is it normal to see such push-outs by multiple clients, by 3 to 6 months at a time? And given what we have gone through this year, what steps can we take to reduce the impact of revenue from specific client order push-outs in a specific year going forward?
Okay, so maybe let me answer that, and then you can ask the next one to Venkatesh. I mean, in terms of the visibility that we have, the two things we are doing is that from a breadth of the customers that we have. So clearly, I mean, as we had mentioned earlier, we are in a B2B business with a fairly high degree of concentration of customers. So if it does happen that sometimes some of the orders can get passed on to in another quarter or so. So the thing which we are specifically doing is really broadening our customer base. We talked about the 3 or 4 geographies where we are focusing and the new wins we have. And every time that we get a new win, it usually starts expanding TAM for us in that region. So that's one thing we are doing. The second thing which we are doing is that once we are already into a customer which we have won, can we increase our wallet share? And with the product portfolio that we have, we truly believe that even with the top leader in the industry today from our optical portfolio perspective, we have probably 80-90% product portfolio overlap. So we feel that there should be ways for us to get a higher market share within our existing customer base. And when I talked about in the context of India private, I did mention that there are a couple of new applications that we are talking about and where we are at an advanced stage, which I think once start happening, we should get larger piece of revenues from the same customer. So that's one part of the question. The second part is it normal in the industry? Yes, I think the nature of our business is a bit lumpy. Our revenue base is still small. So, for example, if I look at the international revenue base was, relatively smaller compared to domestic. So a one deal of, say, $5 million shifting here and there can potentially cause a growth or a degrowth in a particular geography. So that's kind of just a size issue for us. And as we continue to scale up our business, hopefully those issues should get smoothened out to a much larger degree.
Understood. And just a clarification, have you stopped giving out yearly guidance?
Yes. So, in fact, what we felt is that last time when we thought we had a view of a year, which we, again, to our surprise, there could always be things that change. So what we have decided to do is that we will continue to give a medium-term guideline. So we stand by what we gave earlier, which is 20% CAGR on a year-on-year basis. Which specific year and which specific quarter will happen in the near term is a bit difficult for us to predict. But definitely from a medium-term outlook, we do stand by and confirm that the 20% CAGR that we saw is something that is achievable given the traction we have, given the deal flow that we see in the near term as well.
Got it. And the second question is for Venkatesh. Venkatesh, when we look at the order book number, which you have shared, the 579 crore order book, usually how should we read that? Is that something which is executable in FY19? Usually for a particular year, how much of your your order book, how much of your revenue is from order book kind of a scenario, which is 6 to 12 months in nature, or how much is intra-quarter, as a percentage of overall revenue for a specific year?
Yeah, we had a healthy backlog of around 579 crores, of which about more than 80% can be revenued in this financial year itself.
Okay, and how should we look at it, from a normal year perspective? Since you have not given out the corresponding numbers for FY18 or FY17, so generally what portion of revenues in a year come from projects which would usually make it to your order book?
Yeah, so maybe just Sanjay again, just to since it's related to more how the funnel builds up. So the way it works for us is that the order book at any point in time is a deeper reflection of the tender wins, because order book really reflects the tender pipeline, because that's what we get a spread of, time to execute the orders. The run rate business, which is stuff that comes from our private customers in India or to a larger degree from the international customers, that actually is more in the form of guidance which we have from our customers, which you do not reflect into the order book per se. So in the order book, we are only recognizing stuff for which we have physical purchase orders. So I think in that sense, we do have a very strong kind of, visibility from our existing customers as well as the new bids that we're working. So at any point in time, as I said, the order book is a good reflection of the tender base. The run rate business is really a function of the customers that we have and the applications that we are serving, and that's how we are essentially expanding our numbers base,
Understood. And one final quick question, if I not taking too much time. Kumar, any views on the impact which is happening from either 400G implementation or compact modular equipment adoption in the world?
Okay. So first on 400G, we already have 200G solutions today. We have several deployments of 100G last year. We will soon deploy 200G in the same or similar networks. We'll adopt 400G as soon as it becomes more readily available from our component partners. So we are, so 200G is already there. We're just waiting for first customer adoptions. So we are well on track to ride the 200, 400 gig solutions. In terms of compact platforms, I believe we already have a portfolio which includes compact platform for almost all applications. For example, we have a compact platform for mobile backhaul or enterprise services, which is 1400p. We have a more compact version of our GPON portfolio, the OLT. I'm not talking about the modem at the customer end, at the exchange end, which was 2U, which is about 3.5 inches. We have one which is half that size today. So I think, we see no challenges on the compact side.
Including our WDM on OTN, 602.
We also have
applications as well as...
Yeah, now we can add to that, is it?
Yeah, so along with that, even for transport applications like, for example, data center interconnects or metro core networks, we also have compact platforms which have 100 gig line interfaces. So, across all the portfolios of PTN, conventional TDM transport and OTN, we have platforms across all the space, compact platforms and modular.
Got it. Thanks for taking my questions. I'll get back into the queue.
Thank you. The next question is from the line of Gaurav Malhotra from Citigroup. Please go ahead.
Yeah, hi. Thank you for the opportunity. Just had a couple of questions. One is, in terms of just the operating metrics, how much was the India and overseas revenue split this year and compare it to last year? I didn't get that number, please.
Yeah, domestic revenues were for this year 614 compared to last year was 531. Percentage-wise, percentage-wise 82%, and this time it was 82%. Last time it was 65% domestic, whereas international was this time 18% compared to last year 35%.
Sanjay, just one question on the revenue lumpiness. Now, I mentioned it's a B2B business, so there are times wherein it could be lumpy. But, since in the third quarter itself, we were told that, it's going to be like a 5% growth versus, say, maybe a 50% growth. And we end the year with, or in this quarter, obviously, we saw a quarter-on-quarter decline, a meaningful decline back too. So, any sense on, which segment is where you're facing the biggest challenge? Is it that the Bharat phase 2 while the tendering has been delayed, or what seems to be the key reason why the revenue trajectory is not happening the way it should be happening, given what we are seeing globally and in India in terms of the data growth?
No, good question, Gaurav. So actually what happened, since you mentioned that we gave a guidance of around 5% at the beginning of, this year, calendar year, and around late March, I think we kind of got a sense that some of the large orders that we are thinking, and I'm not just talking of the large BSNL order that we got for 300-odd crores, but even, couple of deals in Southeast Asia, just which were kind of all set to come in before the end of the year, got slipped out. Even in a India private customer, a couple of orders, I think, which we were expecting to come, didn't happen. So what happened is between the January time period that we thought that we'll at least do a 5% year-on-year, by March end, when we announced that it's not going to happen, these 2-3 things happened. It just was a little bit of an awkward thing for us this year. Although I think about 3 years back, we had a similar situation where we had, I think FY 14, 15, 16, we had a flattish year. Yeah. And then in the subsequent year, we basically caught up with whatever we had lost in the previous year. So I kind of expect a similar situation to happen this year. But like what I answered in the context of what Mukul had asked, is really the answer to that is we have to broad base our customer base and get larger wallet shares from our existing customers. The tender business, as you rightly pointed out, is always lumpy. But the good news is the backlog that we have on our books is, a significant part of that is tender. So actually for the current financial year, a lot of the lumpiness is hopefully out of the way. And it's now really a question of building up more backlog and continuing to accelerate the run rate. So I would say, we really more, medium term, we think things are going to be steady, but there will always be a quarter or two here and there where things can just get a little bit disturbed.
And so, so based on the order book, you mentioned around 500 and odd, and I think Ritesh mentioned 80% is likely to get, consummated this year during this FY19 itself. Any sense last year what would be the split between your run rate business and the tender business, just so that we have a sense of where we are?
So last year, if I were to split the India business alone, because that's easier to capture between the government and private. So I think out of the 82% that we had India, around 60% was or 65 was government, and the balance was private, So really it was largely, in the India part, largely dominated by the government, which basically had a larger picture.
So essentially 60% of 82 was sort of tender, and around 22 was sort of...
No, 70% of 82 was around tender, and the balance was really the run rate business.
Okay. And you expect that this percentage should sort of improve in terms of lower, the run rate should be more than 30%?
I will say it may improve or may not improve, because we already start with a very large backlog of this tender business this year, right? So when you look at the revenue angle, whatever we have the backlog, a good chunk of that being government, would get executed anyway. But in terms of new wins, I definitely expect that India private will have a pretty healthy growth. But I must also say that there are a huge number of tenders that we have already bid, and in many of them our partners who are SIs are L1. We believe that India government, just because of the growth and the investment in BharatNet Phase 2, will continue to be pretty large this year as well. But the good part is we have visibility into that, so the lumpiness aspect would be hopefully less.
Just last question, so the third quarter also you had mentioned that, it's not as if you have lost orders, they're getting pushed out. And obviously, this quarter was subdued in the last quarter. So then, while without getting into guidance, then you don't want to give a medium term rather than like a 1 year kind of a guidance. But by that statement, should expect FY19 to be high growth kind of a...
Sorry to interrupt, Mr. Malhotra.
Yeah?
Excuse me, sir, your voice is breaking up. Can you repeat your question? We're not able to hear you.
Hello, can you hear me now?
Much better.
Yeah, we can hear you now well, yeah.
Yeah. I was saying that, so you had mentioned in the third quarter that you've not lost orders, they sort of got pushed back. And we saw the same thing in the fourth quarter. So while not getting into, quantifiable guidance, but shouldn't we expect FY19 to be like a meaningfully strong top-line growth kind of a year?
I think yes. Yeah, the short answer is yes. You should see, a significantly good revenue boost this year, yes.
Okay. And in terms, since we're already, out for a month of the quarter, will this be some sort of a improvement over fourth quarter, or is going to be not much improvement?
The fourth quarter was so low that it will be significant improvement over fourth quarter. And okay. I think because the orders are already there, it's just a question of, pushing things out of the system. So we do believe that we'll basically now again, as I said, we had a couple of aberrations, but hopefully we get the run rate and rhythm back. So, yes, this year should be, starting off fine.
Okay, cool. Thank you. That's all from my side.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, please limit your questions to 2 per participant only. The next question is from the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Good evening. Thank you for taking my question. So I had 2 questions. First is, let's say for assumption's sake, all the orders come in FY19. What kind of downside risk to order booking do we have being an election year? I wanted your views on that.
Really nothing. To be honest, it looks like the stuff that we are working on, let's say the private operators, I don't think it is really getting impacted by elections in any significant way in India. Secondly, even the government stuff that we're talking about, the orders are already in hand for a very large portion for what we would need to do revenues this year. And if I were to look at the tenders that we already bid last year, which would just fructify into orders very soon, really doesn't have any election dependence. So I would say even India business, I don't see much correlation for the election for us. International, of course, is unrelated. By the way, there was an election in Malaysia, was announced or something nearby, and that also, happens in other countries. But at a macro level, I don't think there's anything which should impact us.
Okay. And the second question I had was, end of last year, there were a few reports which said that BSNL and Fiber Home, yes, I believe Fiber Home, there was going to be a tie-up to manufacture optical networking products. So is there any update and what kind of threat can we face from that?
It was an announcement. We haven't seen anything before or after that announcement. We believe, like many announcements which happen, it was just something which was announced. We have not seen a single instance of anything which makes us believe that there is any kind of threat at this stage. Since you, by the way, mentioned about the Chinese, which is Fiber Home is a Chinese company, I'm sure you guys have also been tracking what's happening internationally. The only observation I've had in the last 1 week, based on I was actually traveling abroad last week, is that there seems to be a significantly large interest from international customers, and I actually talked to a few in India as well, who seem to be now seriously concerned about supply chain continuity, because of the things which are happening around the world. And we seem to be having a very good play where people believe that at least an Indian company is not into the crossfire, and hopefully the trust and reliability factor would come into our play. So I would say that we should see some benefit of it during the year, but we need to see how it plays out.
Okay. Thanks a lot for taking my question. I'll get back in the queue for additional questions.
Thank you. The next question is from the line of Anirudh Gangar from Nomura. Please go ahead.
Thank you and good evening. 2 questions from my side. The first one is that if I look at the commentary of one of your competitors, Ciena, and also your OEM so-called customer, they've been very, very bullish on India. They've had a fantastic year and they continue to believe that India has done well. And my query is that is there something that, and we've lost it on our OEM revenues, and Ciena was a big customer for us. So is it something that they are doing on something on their own now and we are no longer supplying to them? Is it that they are focusing a lot on the private side and we were focusing on the government side? And what has really enabled them to leapfrog us in terms of market shares, and what would be a strategy to counter that in India? That's my first question. The second question would be on the deferred tax reversal that we've seen in the fourth quarter. Does it have any implications on the validity and of our tax holidays going forward? Does that period get truncated because of this, or there is no impact on that part? Thank you.
So let me answer the part of the first question, and then ask Arnab answer the second part. So at a macro level, yes, Ciena has been doing very well in India. The applications, by the way, where they are competing and they have really done extremely well is in the intercity applications in terms of WDM and the larger platforms. On the metro aggregation, we do have an overlap now with Ciena, and part of some of the revenues that did not come to us potentially leads to the same question that you're thinking, which is that there's an overlap and they may have a reason to push their own products versus ours. But that's one part. We are getting into new application with our existing customers, and that is why we believe that we should be able to recover a lot of momentum in the India private as well. Maybe, Arnab, you can answer the product overlap with Ciena at a macro level, both in India as well as otherwise, and then Venkatesh can answer the deferred tax issue.
So, I mean, the quick summary is what you said, which is we are more focused on the core and long haul, and ours strength is in the access and the edge. But specific to in our products, if you look at our flagship products, which are 1400 and 1600, for 1400, there is no overlap with any Ciena product. This is an access edge product. They do not have any redundant 10 gig access or edge product, which supports all the different configurations of PTN, OTN, MSPP, hybrid, and so on. And they have adopted this product and they sell it widely. They brand it as 6200, and as part of a network solution with their 6500 and 5400, they sell it widely across the world as part of their solutions, right? Then 1600, the other product that we have, which is a converged packet optical product with a terabit fabric. Now, 1600 is a smaller capacity version of 6500. So while they have the same functionality, they usually do not compete because 6500 has a much higher capacity and it sells in the core network, and we sell in the metro aggregation, metro core network. However, in the PTN space, in the PTN solution space, there is direct competition because where both of us sell both the 1 gig and 10 gig CPEs and the 10 gig, 100 gig aggregation switches. So we have more direct competition over there, 1400p versus the 3932 and 1418 slot versus the 8700 and so on. So those are from a direct optical access edge aggregation space. However, in the access, we have the GPON product, and we believe they don't have any product or business in the GPON-based access space. So that's another place where we have seen a lot of business, and we have never seen any Ciena competition, whether in India or elsewhere across the world. So this is roughly how the product overlap and the competitive space plays out.
Maybe Venkatesh, you can answer the deferred tax issue.
Yeah. As per Ind AS, deferred tax asset has to be recognized for the carry forward of unused tax losses and tax credits to the extent of that it's probable that future taxable profit will be available against which unused tax losses and unused tax credit can be utilized. And, since it has a catch-up which has happened since it is the Ind AS we have adopted in this year, and we had to give the financials for last year as well as 1st of April 2016. 56 crore of deferred tax has been recognized in the opening balance of the reserve, and 40 crores and 24 crores has been the deferred tax benefit has been recognized in the profit and loss account for FY 17 and 18. Going forward, any deferred tax credit will be recognized on a quarterly basis. And after recognizing this deferred tax credit for FY 18, the balance unused tax credit was 157 crores as of March 2018.
So just to clarify, Mr. Gadiyar, we have the benefits now up to 157 crores of profit. That's the benefit that we have, where after that we start paying corporate tax rate. Is that my understanding correct?
Yeah.
Right. And just one final clarification from on.
Yeah.
Yeah. Just one final clarification, Sanjay, just on your medium-term guidance. Could you define medium-term? Are we referring to 2 years or a 3-year CAGR of 20%?
I would say, starting from last year, if I were to add 2 more years after that, so we are really, if I were to say next 24 months, that's something which is visible based on the deals that we see, based on the pipeline. That's what I would define for now.
So that would be from FY 18 to 20, the coming 2 years, or 17 to 20?
I mean, 18 to 20, so 17 we basically started to give a guidance that we see a 20% CAGR over a 3-year period. We stand by that because within the same period of time, and one year has gone and we still have 2 more years, we still feel that momentum is possible. Clearly, I think this year and the next year we'll see a lot of that coming to fruition. And as the year progresses, we should have visibility into the year after as well. So I'm saying, we're kind of having a fairly good view of things in the next 24 months, and that's why I said that that's a medium thing which will say.
Right. Thank you for the clarification. I'll get back into queue.
Thank you.
Thank you. Ladies and gentlemen, that is the last question. I now hand the conference over to Mr. Pranav Kshatriya for his closing comments.
Thank you, everyone, for participating in the call. I'll hand over call to Mr. Sanjay Nayak for his final remark.
Thank you, everybody. First of all, we've had good interactions and a good exchange of information. So I hope, we were able to kind of give you the view of the business. And we've tried our best to kind of be transparent in as many things as we could. So when we found in March, for example, where the things look like, we kind of gave an early warning indication. Right now, we kind of given a view of things as it looks now, and we feel very confident and comfortable that we should be able to see the growth momentum that we could not see last year, but should build up this year. So a combination of some of the spillover of last year plus what we're going to do this year, we feel that this year should be a very strong year and should set a good stage for the next few years to come as well. So thanks again, and look forward to interacting with you again.
Thank you.